Hey, hello, Vetavia community. It is Hammer this week with your mortgage market update. Some interesting things to chat about. We are joined with our returning guest, Randy Teakell. Randy, always glad to have you, my friend. How you doing?
Doing well. Absolutely well.
That sums it up. Even if you weren't, you'd lie. You wouldn't put us through it. You'd be like, "Hey, I'm awesome."
Yeah.
You're always got a smile on your face. I got to give you credit. You always do. So, well, it is great to have you. Do me a favor for anyone that we always have new veterans watching. So anybody that hasn't seen before, maybe just take a minute and tell them a little bit about yourself.
Okay. So I am a long time mortgage guy. Been lending since June of 1989. So just hit 34 years, and I'm a broker. I do primarily VA loans, but anything residential, and love what I do. Love helping people, and feel like we make a good impact.
Yeah, definitely. So, well, thank you for joining us. Remember, everybody, if you're here, go ahead and ask your questions, share your comments. If you are here live, let us know and just put a hashtag live or anything else that you want to do to be a part of that conversation. If you're watching on the replay, of course, we're glad to have you as well. I know many of you do watch on the replay. Go ahead and give us a hashtag replay. Just let us know that you were here. We do monitor this post, so go ahead and ask any questions or share any of the thoughts that you might have. And with that said, let's jump right in and let's start talking all about rates and get into that. So remember, this is not an offer to lend. When we talk about rates, we're talking about averages and generalities. Your unique situation is going to have its own factors. You always want to make sure you're talking to a professional and that you do go ahead and shop your rate. Who said hello who's from North Carolina? I see Facebook user from North Carolina. I am in Western North Carolina in the Smokies, Great Smoky Mountain area. In fact, the park is right behind me. So, but would love to know who's from North Carolina. Let me know in there. William Caballero. William, are you a veteran or are you a mortgage professional or a real estate professional? And just curious, let me know in the comments. So awesome. With that said, let me turn that back off. Okay. And let's get into the rate forecast and actually the recap rather first and tell you a little bit. So last week I said, all right, we had the Fed meeting and, sometimes you just got to go with your gut. And I warned everybody that I felt that this was not going to be advantageous for us. I didn't think that we were going to get good news at the Fed meeting. We talked about some potential volatility, which we did see. And I said that afterwards, I felt that rates were going to creep up. My opinion was that rates were going to creep a bit over the coming weeks, but would only reach the worst levels that we'd already experienced for 2023. And that the increase would likely be about 0.25%. So from last week's best levels, we actually have increased and we have seen them move about 0.25%. And we are testing those same levels that we've seen, kind of the worst rates that we've seen for 2023. And in fact, the worst rates we've seen, Randy, you've been doing this for 6 or 7 months now, right? You've been in the mortgage business. How long have you been in the business?
That the same 6 or 7 months, 70 times. So
yeah. So I mean, when was the last time that we've actually seen rates? I can think back. Rates in the sevens were, I think, in like 2000, maybe 2001, but 2000.
Yeah, 2000 is what I did a little quick research and read a couple articles, and they said the worst since 2000 is where the rates are.
Yeah, that sounds about right. So, well, rates, they have started moving higher as we warned would happen. VA rates are averaging the high 6s to the low 7s. If you're currently out there looking for a home, you can expect to be quoted rates that are in the high 6s or the low 7s, depending on your credit score and a couple of other different variables that come into play. Conventional rates, if you're not using a VA mortgage for any reason, conventional rates are averaging in the mid 7s to the high 7s, but they can be in the 8s in some situations, especially if you're putting very little down. One of the benefits of a VA mortgage is that you can put very little or no money down and not have a huge hit to the rate for that. Whereas on conventional loans, when you're putting less money down, there is more risk and the rates tend to reflect that. So you could find that you're going to be in the 8s in some scenarios. How do those rates look to you in the field, Randy? Does that sound about right?
Yeah, I mean, obviously the rates that I've been locking for VA loans were, a month ago they were in the mid 6s, and they're just kind of easing up, and locked a couple yesterday, which obviously I haven't had a chance to lock one today, but locked a couple yesterday in the high sixes. Yeah. So it definitely has been upward mitigation for a while now, but obviously just really solid, steady up currently.
Yeah. And everybody wants to know, well, hey, Helmer, tell us a little bit of the forecast. When are rates going to move down? And the forecast is they're not. I'm like the weatherman that has to tell you the hurricane is always right around the corner. Rates are likely to continue to move a little bit higher. I don't think they're going to stay this term higher for longer. I'm saying this, and I'll tell you why I laugh when I say this. So I don't think they're going to stay higher for longer, but I do think that they are going to move a little bit higher from here and then fall back down. So part of the reason that we are seeing mortgage rates in the situation that we are is because at the Fed meeting last week, the Fed members were very clear that they are going to hold the Fed policy rate higher for longer. And that's a term that's been used a lot from different Fed members, and it's been in the media, those exact words of higher for longer, that they're going to raise this Fed funds rate probably one more time this year. And right now, markets are currently looking at seeing that happen in December. Now, that doesn't mean that rates would go up in December. If markets think it's going to happen, we tend to see mortgage rates react soon. They react more before it actually happens. And we've talked about that in the past. So we will see right now there's about a 40% expectation that we'll see at least rates go up a little bit more by the end of the year. There's about a 20% expectation or probability that that'll happen at the November meeting, which is actually the end of September or the end of October. The 31st, it starts on the 31st of October and the statement comes out on November 1st. So we call it the November meeting, but it really is just at that first day of November. It's almost, it's about 6 weeks from now. So rates are very likely to remain in the range that we've grown very used to. We're going to hear about, the 6s into the 7s for VA loans, 7s into the 8s for conventional loans. And we shouldn't expect them to go down anytime soon. In the next 15 days, I think they'll actually creep up a little bit. In the next couple of weeks, they're going to stay within that range that we're finding. We are close to capping out, but rates are not going to move significantly lower until 2024 sometime. And that date keeps getting pushed out because if you remember, Randy, in the past, you've got your pulse on it. Everybody in the mortgage business, a lot of us, prognosticators, forecasters, we thought we'd be leg deep in a recession by now, and that rates would have dropped back into those low 6s, maybe the high 5s. That's what everybody was expecting to have happened by now, and it hasn't. Right.
And I think it has everything to do with what the Fed is fighting, et cetera. I think a couple of folks that I was reading this week said that the Federal Reserve is fighting the federal government when it comes to capping off inflation. A couple of the Fed folks said, like this Neil Kashkari, and I'm not sure if I said his name right.
Yep, Neil Kashkari.
Yep. He said that he's not sure that rates are high enough yet.
Yeah.
And to make that difference that they're trying to make. And I'll just tell you that for the realtors and mortgage folks, we're definitely in a recession.
Yeah.
But it hasn't necessarily trickled down to the rest of the economy because labor is still pretty strong. And that's one of the things that the Fed have mentioned over and over is that they want to see pain, and they want to see specifically pain in the labor market. So that's a tough thing that they're treading right now.
And you're absolutely right. And the reason for that, the reason the Fed wants to see pain in the labor market is that when people are losing their jobs or afraid of losing their jobs, they spend less money. When there's less money being spent, that means that demand goes down. So then supply goes up. And when people have too much of something, how do they get rid of it? They lower their prices. So that's the oversimplified version of the economy. And right now, what we have happening is that people are out spending money. Now, a lot of it, though, is money that people don't have. And many of you that are watching may have this same scenario. Maybe you're running up credit cards right now to make ends meet. Maybe you're out there, the groceries are expensive. Oil prices are going up behind the scenes, which means the price at the pump where you see that is happening. We've seen gas prices in my area move up 30-40 cents recently. So all these things kind of, they build up. And most of the time what happens is that in order to be forced to make ends meet, people are using credit cards and they're using other kinds of credit. And that's really the biggest difference between now and past recessions and past economic scenarios that are very much like this one. Like we would argue in the 70s when inflation was a big issue, is that in the 70s, remember Diners Club, I think, was like one of the first credit cards, and it was a very elitist kind of a thing. People didn't have credit cards. They didn't have credit. There was layaway and that was about it. And now it's a very different world. And consumer credit has hit record levels. It's in the T for $1 trillion range. And because of that, people are continuing to spend, and they're spending money they don't have, but that money is being spent. That's keeping the economy strong. And that's why the Fed has had to continue to turn the screws, raising rates, trying to fight that wave and get that economy down. And the idea is once people have, the pain of jobs, that'll slow down the spending, and then the economy will get back in where it needs to be. So, well, why, with people looking at this and it sounds kind of negative with rates being high, why would somebody want to buy a house now, Randy? Why is it still a good time to buy a house?
Well, I think it's actually one of the better times in the last 3 years to buy a house. And the reason being is that a lot of people have decided to stay on the sidelines just because of rates, for one thing. And so the market's not as crazy as it was in 2020, 2021, first part of 2022. Crazy things were happening, this bidding wars and all this sort of stuff, because with the rates as low as they were, everybody wanted to be in the game. And so then there's still only a finite amount of inventory on the housing side. And that has been, when you got everybody wants a house, but there's not enough houses to go around, then that's what pushes housing prices up. In our case right now, it's been real steady for me. Like out of the last 28 VA loans I got, 24 of them had significant seller concessions. And so they're not moving like they were before, where in a weekend you put your house on the market on Friday, you got 78 offers over the weekend, and then the people are just going crazy, outbidding each other, etc. Now people put their houses on the market, and 3 or 4 weeks later they have to decide if they're going to lower the rate, the price, or make some sort of a 2-1 buy down type offer, or something that makes sense. But the bottom line is they're willing to negotiate. Yeah. And you can pretty much count, and I don't want to get in trouble for saying this, but that rates are going to come back down, because they're as high as they've been since 2000. There's a pretty good chance, in my mind at least, and everything that I read, that says in the next couple of years they'll come back down. Yeah. But if they come back down, then those people step out of the sidelines, they get back to buying full blown, then crazy stuff happens again. So you're better off to buy now when the inventory is available, at least to some extent, and worry about your rate being able to renegotiate it down the road, as opposed to waiting. Obviously, you got a couple of years that if you're not in a house, that you're going to be paying rent and paying someone else's mortgage. And then you're going to be in a crazy market if you wait till the rates come down. So yeah. That's a long-winded answer, but the bottom line is that I'm really proud for my people that are able to negotiate currently. It's not crazy.
Yeah. So. And that's something for people to realize too, is there might be concern that we're in a housing bubble, and
Hammer's having to think about that for a minute.
Randy, you there?
Yes.
That was a weird one. Yeah. I think StreamYard gurgled there. So anyway, what would normally happen when rates move up the way they have is home prices would generally come down a little bit, and they wouldn't drop. They wouldn't be a huge move, but it's an affordability factor, and it's almost a fulcrum. So as one side of the equation goes up, the other side comes down. When rates come down, people have the ability to spend more, so then home prices can escalate and they can go up. The reason that we did not see that happen this time is because of all the people who have such low mortgage rates from the pandemic era, and all of that reaction to the pandemic. Again, we're not going to make this political, but the reaction to the pandemic it broke our economy. And it put us in the situation that we're in now. It created inflation. It broke supply chain and, created supply chain problems and broke the supply chain. It also broke housing because you have all these people in homes who either have no incentive to move or can't even afford to move, because how do you sell a house with a 3% mortgage to buy a house with a 7.5% mortgage, especially if you're upsizing or you need more room because of a new baby or some other thing that's happened that the normal housing market would have. So because of that, home prices are not going to go down because the inventory is going to continue to be an issue. Even as rates fall back down, that would in theory put a little more inventory on the market, but it also creates more demand. So it's almost like the tide brings up all boats. And that's why it's very unlikely that you would see us being in what's called a housing bubble, or where we're going to see prices drop significantly. So, just some stuff for people to be aware of. So awesome. Well, Randy, I'm going to wrap it up. Is there anything you'd like to add or leave everybody with?
No, I mean, I think the biggest thing is just that, from my perspective, people are going to have to look at their own situations and see if it makes sense to do. There are times when renting is the right answer, but for the most part, I've been doing this for 34 years. And when I started, people were thrilled to be refinancing down into the 12s and 13s. And so obviously the housing cost was different then as well. But for the bottom line is that, people have to live in a house and you have to deal with the rates. The bottom line is to learn how to shop for a lender and make sure that you're dealing with someone that you trust, and we're going to all face it together.
So awesome. Well, thanks again for joining us. Remember, everybody, you can join us each and every week. We do this 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And I'll see you next week. Goodbye, everybody.